Keep charging ahead. CNBC contributor Tom Lee is Fundstrat's co-founder and head of research. He is with me, as you can see right here, Post 9. Welcome. It's good to see you again.
Great to see you, Scott.
So how timely. You just raised your S&P target to 48.25. So you were a little too bullish last year, and you think you're not bullish enough for this year.
Yeah. We're at the midpoint of the year. We took a look at what could happen in the next 6 months, and I think there are some positive catalysts coming up, including, inflation next month. The June CPI could fall to 3%. It really takes the pressure off the Fed. We've got the generative AI story that I think is gaining traction. And I know there's a lot of skepticism of this market, but advanced decline line hit an all-time high last week. So I think we build upon those gains, and we set new highs this year.
Are you sympathetic to the skepticism that you say still exists? Why do you think people are still so skeptical of a rally you think can keep going quite substantially?
I think I understand why investors are skeptical, because we're in a hike cycle and the curve's inverted. But our view has been that this has been an inflation war. So the Fed's not trying to kill the economy, it's trying to kill inflation, and I think they're winning. I think it is still going to be a tough battle. First half was a game of inches. It wasn't like the stocks went up every week, but I do think we're in a buy the dip regime. So I think it's still a street fight, but the bulls getting the upper hand, and we gain maybe as much as 12%.
Do you think the Fed thinks that you can do one without the other in terms of killing inflation without killing the economy? Because every time you hear Jay Powell and whoever else related with the Fed talk, they mention how the labor market is still strong, arguably too strong for their liking. Consumer is still too strong, maybe for their liking. And the economy itself is hanging in there, I think, a lot better than even they expected it would.
Yes, I think the Fed has an optics issue because, 4% inflation doesn't look good for them. But the internals of inflation are really encouraging. Goldman had a nice piece today looking at that. And first of all, used car prices, which have been really pushing inflation, are set to roll over. That has nothing to do with the stock market. Housing is finally starting to kind of catch up and will start to reflect market prices. That's rolling over. That has nothing to do with the stock market. The labor market's cooled off a lot. We'll get the JOLTS report this week, but average hourly earnings are growing at half the rate it was last year, and 4%. That's where the Fed would like it, and that has nothing to do with the stock market.
I understand, but I mean, it's the idea that services inflation is still too sticky for the Fed's liking has nothing to do with any of the things that you just mentioned that have come down a lot. And that seems to be the problem that the Fed has and why they're so apparently resolute in the way they talk about what they're still going to do.
That's right. Now, 7 items make up services. And, core services ex housing is running actually a pretty decent rate right now, like in the high 2s. But financial services is being inflated because of higher interest rates. Travel could have a seasonal problem that's being fixed in the next 2 months. Because as we know, like when you look at things like airline demand, I mean, their prices are cooling, even though it still looks like they're inflating. And then restaurants is tough, but that I don't know if the Fed wants to kill the economy just to get restaurant prices down.
But they need to kill demand to some degree. At least that's what they would suggest. And that's what, Jay Powell seems to refer to anytime he makes comments about what's going to be ahead. Hike in July, maybe there's another hike this year, all because they're not satisfied that they are full enough into what they would deem to be restrictive territory.
That's right. I think that they're going to have an easier PR story after the June CPI comes out next week, because headline CPI will be down to 3. Now people can start to believe there's real progress because you've gone from 9 to 3 on inflation. And then they can argue that a lot of the 500 basis points of hikes is still going to kick in. So I don't know if there's the urgency to keep hitting with 25 basis point hikes.
Yeah. You've been right, obviously, through the first half of the year, but the skeptics would come back and say, and they do, and the reason we talked about why people aren't fully willing to get on the train, so to speak, because they think that things still are going to come, that earnings are not going to live up to the hype, that multiple expansion that took you to where you are now can only go so far, and that's going to be upset by earnings that aren't going to live up to what the expectations are, that they're essentially going to have a V-shaped recovery.
Yeah, fair points. But the PE ex FANG is 16 times. With a 10-year at 3.8, the PE should be closer to 18 or 19. Earnings revisions have been positive, and Q2 is coming out next couple weeks. But X Energy, it's going to be up year over year. So we've already had a nadir, a bottom in earnings in fourth quarter, and now it's turning up. Advanced decline lines at an all-time high. So to me, I think investors are starting to buy individual names again.
Is there a level of interest rates that makes you uncomfortable? 2 and 5 year today are the highest they've been since March. Do you think about, the prospects of rates going back up and what that could mean to your projection?
Yes, I think if inflationary pressures resurface, that's a headwind, because that means we're in the 70s again, not winning inflation, but still fighting it. And then I think the other risk is if expectations get too high. It's just, Scott, our team talks to dozens, maybe hundreds of institutional investors every week. There's a lot of skepticism out there. So I don't think people are expecting much in the second half. That's why we can be more bullish.
Yeah, let's bring in somebody who's not expecting much. Good, anyway, in the second half. CNBC contributor Greg Branch of Veritas Financial Group. It's good to see you again. I like when we do these. I like when we do these conversations and debates between you and Tom, because you really could be hard pressed to find two incredibly opposed positions on the same thing. So you heard what Tom said. What's your problem with it?
So let's start with where I actually agree with Tom. The headline number may very well come in at 3% next month. And the question then becomes, are we going to look at the window dressing, or are we going to look behind the window dressing? Because ultimately that will be because energy has declined significantly. Certainly energy is not pointing to a favorable or growth-oriented second half globally. And it'll also just be because of the base effect, lapping that 9% from last year. And so I don't think the Fed's going to pay attention, nor investors are going to pay attention to the window dressing. I think they're going to look at core. And I think core, like it has every month since October, will grow 30 to 40 basis points. And I think that is the Fed's target. I do agree with your pushback on Tom. I don't think there is any immaculate disinflation. It's hard to get less demand without causing some slowdown in growth. We can call it recession. We can call it destruction. We can call it whatever we want. The Fed's been very clear about this. In order to reach their target, unemployment needs to be significantly higher than where it is now to cause the proper demand destruction. Lastly, I'd say all of the forward indicators that I'm looking at, because by no means am I tied to a bearish view. I yearn for the day.
Well, you seem it, though. You sure seem it, though, because you've been tied to it for an awfully long period of time now, and you don't seem to want to untie yourself in any way, shape, or form.
Well, I'll be able to untie myself when we get an ISM that is not indicating a significant contraction going forward. I'll untie myself when the purchasing barometer and the new orders barometers are not at recessionary levels. I'll be able to untie myself when credit conditions are not deteriorating, and when we see how the consumer digests the $5 billion a month in school loans that we're about to have to pay back. And so with a deteriorating consumer balance sheet, with estimates far too high, I think ex-FANG, the S&P is trading at more like 18 times, not 16, which is an inappropriate multiple for a slowing environment.
All right. I want to have Tom respond to all of that. What do you say?
It's a lot of things, but I just start with ISM. It was a bad reading, but it tells you a lot about positioning when you have a bad ISM and the market's up today, right? Because it's not a great number. It just shows you people have been betting on bad news, positioned to be more on the short side, and instead of getting this response of negative price reaction, we're getting rallies. On inflation, I find that there's a lot of conviction inflation sticky, yet headlines at 3. I don't think most people would have said it would have been 3 by mid-year. Core is probably going to be 0.2 month over month this coming month, especially it depends on what happens to used cars. It's not 0.4. It's really decelerating. And I think if we see it as an inflation war, the Fed's getting really ahead of this. But ultimately, the stock market is broadening, and there's less skepticism, and there's more companies speaking about better visibility. Mm-hmm. Those are things that normally cause fundamental investors to buy stocks.
How about that, Greg? The fact that it was an easy market to pick at and say, you know what, this is a magnificent 7 market, and the S&P 493 doing nothing. And that's changed a bit over the last month, hasn't it? And I'm wondering why that doesn't move you in any way to see that market breadth is different than it was. And that's a positive sign for why bulls feel the way they do.
Yeah, if the duration was a little bit longer of the suspension, I would agree with you that it's a positive sign. I don't know if any of us base our investment cases on 4 weeks of data. And so, if we're going to talk about a longer series of broadening, then certainly that would get me to reconsider some things. Point of fact, I just want to clarify this. You cannot say that core is decelerating. You can say that you think it might, but the fact is that it has risen 30 to 40 basis points every month since October. That is not a deceleration. And so it very well might, but we can't say that it has.
No, but sure. But see, I feel like you're in the same boat, though, so to speak, of saying, well, because the Fed's done this should happen. And because, earnings are too high in your mind, this should happen. And a lot of what you have said should happen hasn't happened. So at what point do you say, you know what, maybe what I thought was going to happen doesn't happen?
Yeah, let me distinguish the difference. So I'm pointing at 8 months of data, right? And the distinction I'm making is that if we have 8 months subsequent to this conversation of the rally broadening, then of course I would have to change my view. And so the distinction I'm making is things that we're observing over 4 weeks versus things that we're observing over 8 months, like the ISM being down 8 months, the likes of which we haven't seen since 2007 to 2009. And so all of the forward indicating things, all of the things that we look at to tell us where we're going, including the level of mortgage rates, including what's happening in the housing market in terms of a rebound that's going to make this fight very, very difficult for the Fed. All of those things are not pointing in a direction where I can believe that we're going to have a 245 number next year on the S&P, or I can believe that we're going to have 8 or 9% growth in the fourth quarter.
See, I think that, both sides are in a sense so dismissive of the other person's case, not you and Greg specifically, but generally speaking, whereas the bulls like you say, well, things are getting better, inflation's coming down. Bears like Greg say, no, the leading economic indicators all point to an economy that's going to weaken even further. The yield curve remains inverted, which you don't pay attention to because you focus on the other positive things you're looking at. How can you both be looking at two markets, two economies, and come to two distinctly different conclusions?
Yeah, we're in a gray zone, right, where it's not decisive. Just to sort of build on what Greg was saying on core at 0.44, last month, the May number, 43 of the 44 basis points of core was housing, used cars, and financial services. Financial services is Fed-induced. Used cars are about to roll over, and housing we know is going to roll over. So you now take core is actually running at 0.01 month over month without those three things. This is the internals that we look at. Those are, I think, to us leading. But you're right. I think the aha moment is when the Fed can point to progress that we can no longer dismiss. And I think if inflation's got 2 and then next month's going to be, a 3 and it's going to be high 2s, low 3s for a couple months, I just think the bond market and investors suddenly can't say inflation's a problem. And that's going to change how people view this inflation war.
Greg, do you feel like, FOMO is going to get the best of some bears too? In thinking that, look, I got 6 months left. And a large number of people missed this move because they weren't positioned for it. Not only mentally, psychologically, but the way they were literally positioned within the market, they missed it. So in some respects, they're going to chase it. And the longer people are willing to chase it and realize that there may be fear of missing out, that's going to take the train down the tracks. And you're still going to be standing in the station trying to hail down the train as it's already gone down the tracks because you feel like that things should be working in your favor, but they're not.
It's a fair point, and my thesis coming to fruition is not necessarily working in my favor because it's hurting all of us. I do love to make that distinction. Look, I think June was a FOMO month. I think July up in until that Fed meeting where they raise rates will be a FOMO month. And then I think the FOMO will be over, much like it was in August when Jerome Powell had to come out and recertify and rearticulate his intentions. One area where I disagree with Tom, it's relevant to what we're talking about now, is I don't think housing is going to roll over. Right now, we have new bills accounting for about 2 to 3 times their average in purchases, and that's because we have a base level of homes that are not hitting the supply side. Demand has not been destroyed in the way that the Fed would have liked, and we're seeing actually a reinvigoration of the housing market despite these higher mortgage rates, bolstered by wage growth and those pandemic level savings.
Well,
So
that's
I don't
exactly.
think
That's why. But again, like people would look at that and say, well, that's a positive sign. That shows me that the economy can withstand what the Fed's done, and it doesn't have to bring the entire economy to its knees. I see Tom shaking his head in agreement because that's the case that I hear. I'll let you take it over.
Yeah, and in a way, the Fed is creating the housing tightness because with high rates, it's making it difficult for builders to build and for construction to take place. So in a strange, ironic way, we need some easing of conditions. But I do, on your point of FOMO, Scott, I think it's actually really powerful because if you look at the years where the market's up more than 10% in the first half, and you're negative the prior year, 90% of the time you have follow through in the second half with a median gain of 12. So there is real performance issue. People who've been recommending defensives have negative returns year to date, whereas cyclicals are up almost on average more than double digits. So I think there's a really huge repositioning that has to take place.
We're going to leave it there. I'm grateful for both of you being with us. You guys could easily both be grilling and chilling already. But I'm glad that you took some time to have this conversation because I thought it was a good one. I appreciate it very much. Have a good 4th. Greg Branch, we'll see you soon. Tom,
happy
you as well.
holiday.
All right, you as well.